This is Nick Radge, manager of the Harbourside multi-strategy wholesale program. And today we're going to be talking about our July performance, July 2025. For the month, the program finished up 4.7%, which added nicely to last month's gain of over 4%. Year to date, we're still slightly down 0.38%, but over the last 12 months, we've returned 31.2%. So having a look at the key highlights for the portfolio this particular month, US continues to be the heavy lifter. The US component of the portfolio added 5%, whilst the ASX component of the portfolio was actually down very, very slightly. US indices added 2.2% for July. The Australian Small Ordinaries did add 2.8%. But the equal weight index actually declined 0.6%. As I've expressed before, this portfolio is an equal weight portfolio, so we're not reliant on those outlier stocks that tend to push the indexes up like that. General market trends, as I said, US has been doing the heavy lifting for about 12 months. That's probably going to continue unless we start getting interest rate cuts here in Australia. But the other interesting fact is that we're now 3 months into the seasonal weak period, the sell in May and go away, but we've had 3 positive months. Now, interestingly, that's only happened 17 times since 1950, and it actually does lead to strong outperformance in the coming 12 months. So we'll keep an eye on that. Saying that, August tends to be quite turbulent, and especially in this part of the election cycle in the US. So it's highly unlikely that the low volatility that we've had over the last 3 months will persist through August. Let's take a look at the Australian Equal Weight Index here. And as you can see, it's really hasn't moved anywhere for about 12 months. Quite frustrating, not much trending going on here at the moment. But as we've seen in historical periods, really before 2009, actually, the ASX portion of the portfolio was what outperformed, and the US underperformed, and really since 2009 it's been the other way around. And that's why we include 2 portions in there for that little bit of extra diversification. So one of the key, some of the key benefits for advisors with using this portfolio, it does act as a diversifier, and it does have lower correlation to traditional asset classes. We'll take a look at those correlations very, very shortly. It complements or mitigates losses during market declines. We do have a 100% cash mandate if required for sustained declines. And in periods of time, such as the GFC, which don't come along that often, but they can do a lot of damage, these kind of portfolios will be 100% cash and will sit on the sidelines. And that's one of the reasons why we are able to achieve a lower correlation. We do seek outperformance. It is built to be a high growth strategy over the longer term. And as a result, you will get a little bit more volatility. Being a quantitative strategy, we attempt to completely remove any human bias during emotionally charged market environments. June was a very good example where we had the US attacking Iran, and that caused some instability in that period of time. However, the portfolio weathered that and came out the other end in June quite nicely, adding over 4%. We will generate returns during extended periods of sideways scenarios, such as lost decades. We've proven this all the way back between 1968 and 1982. We're able to look at the US portion of our strategy back in those periods of time, and we can see the outperformance more recently in the US again between 2002 and 2011, which was the lost decade. So something to consider there over regular asset classes. This product is not available outside of Shartru, so that's another benefit for advisors. Gives them a talking point to offer their clients something a little bit differently. If we have a look at the correlation between various asset classes, You can see here that the multi-strategy against the ASX 200 has a correlation of 0.25, against the small ordinaries 0.33, equal weight 0.24, and a 70-30 portfolio 0.26. Very low correlations against gold and bonds, and against the S&P 500 0.25. So very low correlations there. And we are able to do that using an index unaware strategy. We're not cap weighted. We do have a defensive mandate, and we do split between the US and the Australian markets. So that's our recap for the month of July. If you do have any questions, feel free to drop me an email or give me a call. My email address is nick@thechartist.com.au. Thank you.